Hi, this is 2023 company account discussion. So this is the hardest company account ever given when you're comparing the last year uh, past papers. This is the hardest. So when you're answering and when you're adjusting the additional informations, you have to adjust all these first five adjustments together because these all five is relevant to your property, plant, and equipment, right? So first, from the first adjustment, it simply says that they didn't consider factory depreciation when they are finding the cost of the production. And the second one is given about the disposal of motor vehicle. And these are the conclusion as a closing date. And the land was revalued. And then the company was purchased a new factory plant, manufacturing plant, and the information that regarding that, right? So actually, you have to adjust the building depreciation, plant depreciation, and then you have to adjust this first adjustment. So these all are combined together. So I will solve first the second adjustment. That is quite easy here. It's given the information about the disposed motor vehicle. So here the motor vehicle owned by the company was sold on 1st of April 2022. So which means as at opening date they disposed the motor vehicle for 4,000 and gain a disposal gain 600,000 and then the accumulated depreciation on that date was 2,100. So in this description and the table is nothing given regarding motor vehicles because the motor vehicle was disposed on opening day. But here the cost and accumulated depreciation given. So here the cost is given as a closing date and it says the motor vehicle disposals they recorded correctly. So that's why there is nothing about motor vehicles in this. But this motor vehicle disposal happened within this year. So you have to present that motor vehicle disposals in property plant and equipment norms, right? So you have to mention in a separate column motor vehicle and the motor vehicle accumulated depreciation on that date is 2,100. So that is the opening accumulated depreciation as well because you disposed this motor vehicle on 1st of April 2022 as in opening date. So that is the accumulated depreciation that you transfer when you're disposing that, right? So opening accumulated depreciation of motor vehicle was 2,100 and you dispose that when you dispose the motor vehicle. And then you have to find out here what is the cost of the motor vehicle that you disposed. So here, uh, the accumulated depreciation of that motor vehicle was 2,100 and you dispose that for 4,000 and you gain a disposal profit 600. So that 600 is a disposal gain. So that disposal gain you have to record in the income as well as in the motor vehicle disposal account. Then you can get what is the cost of the motor vehicle that you disposed. So the cost of the motor vehicle that you disposed is 5,500. So that you should mention here as opening balance of motor vehicle 5,500 as well as you have to mention here as it's disposed, right? So that's how you're recording motor vehicle disposals here. So you have to record the motor vehicle opening cost as well as opening accumulated depreciation. And also you have to record the disposed transactions over in note number 4, property plant and equipment, right? And yes, this is my course. So I'm doing classes in English and Sinhala medium for local learners. So if you're seeking new classes or your friends seeking new classes, just give me a call. And yes, this is purchasing that new plant because you have to do that adjustment. The plant because you have to find out the plant depreciation and the factory building depreciation to adjust the first adjustment. So here it says the company purchased a new manufacturing plant on 20th March 2023 for 10 million, and it has been debited in to the manufacturing plant account. So this 10,000 already debited the plant account. So including that, the plant account opening balance given here 38,000. So you have to subtract the 10,000 from that 38,000. Then you can get the opening, the actual opening plant balance. So it should be 28,000 after deducting this 10,000 new purchases within the year, right? And the installation cost and the initial testing cost of this plant incurred during the month of March 2023 were 2 million and 1,500 respectively. Both of these cost items have been included in administrative expenses. The initial testing cost considered the raw material cost of the goods manufactured 1 million and a professional fee 500,000. So the goods produced during the initial testing have been distributed free of charge for sales promotion. So this is a very interesting adjustment, and this is a very uh, unique one compared to the last years. It's a very fresh adjustment, right? So what we have to do here, uh, you have to identify the cost of that new plant, right? So purchasing price 10,000 and installation charges you should consider under cost of that machine of that new plant, and the total testing cost was 1,500. That 1,500 includes raw material thousands and professional fee 500. So that professional fee 500 you should add to the cost, right? And as per the LKS 16 new update, that initial test run, the raw material cost, we do not consider under cost. We should consider that as an expense, right? So the initial test total cost was 1,500. From that, 500 is professional fee, and that 1,000 is material cost. So that out of that professional fee 500, you should consider under cost. So your cost of the new plant is 12,500, right? So that amount is the amount that you should enter in the note number 4 under plants. So here you should mention additions 12,500. So how you got that 12,500 cost? Purchasing price of that new plant, installation cost of that new plant, and the professional fee of that initial test run, right? So total over that, your new plant cost was 12,500, right? And what they did, they recorded installation and professional fees altogether in the administration expenses. So you have to deduct that total 3,500 from the administration expenses. That's not relevant for the admin expenses, right? And the output, that the product that you got from the initial test run, you distribute a free of charge as sales promotion. So the cost of that initial test run, the material cost 1,000. Here, what you did, you distributed that as sales promotion, right? So that 1,000, the raw material cost, you should identify it under distribution expenses, right? So should I 1,000 plus the raw material cost into distribution expenses. Now you can find out the plant's depreciation for the current year, right? So this 12,500 was added as a closing interest. So you do not need to find out depreciation for that. But you have to find out depreciation for the plant opening balance 28,000. So this 28,000 worth of plants, the useful life over there is 7. So 28,000 divided by 7, your depreciation for the current year is 4,000, right? So that's how you are adjusting this fifth adjustment. So this is the hardest, and this is the unique, and this is the very first adjustment that compared to the last year's. Right? And now you can do the first adjustment. Here, what happened? 10,000 units of goods were produced during the current year. 10% of these units will remain unsold as at closing date. So your closing date value is given for that 1,000 units because you produced 10,000 units and 10% were unsold, right? The depreciation relevant for the production of goods has not been considered in the computation of the cost of sales and the cost of closing finished goods. inventory shown in the triangle. So assume that there were no work in progress inventories in the business. So here, buildings depreciation 2000 because buildings opening balance 28,000 and the useful life 14 years. So 28,000 divided by 14 years, the depreciation for the current year is 2,000. And for the plant, we found depreciation in previous slide 4,000. So altogether, the depreciation that they didn't record when they are finding the cost of production is 6,000. So that's 6,000. From that 6,000, 90% you should add it to the cost of sales because in the current year, your total production was 10,000 units. So from that 10,000, unsold units were 1,000. So which means that 9,000 worth sold, 9,000 units were sold within the year, right? So the depreciation that you missed in your production cost is 6,000. From that 6,000, 90% you should add to the cost of sales, and the remaining 10% you should add to the finished. So that's how you are getting the cost of sales correct. So cost of sales in given it's given in the chart balance. To that amount you should add back that 5,400 depreciation that relevant for the production that you missed, and your closing stock. Uh, so finished stock given in the trial balance 6,000, 3,600. To that you should add the depreciation first 600, and also you have to add the finished raw material because in this, so if you when you are presenting the closing stock, that closing stock should include raw materials, the finished raw material, finished work in progress, as well as the finished closing stock, right? So that's how you are adjusting first adjustment. So now you see when you're adjusting these information and these types of adjustments, you have to read the all adjustments that are along the proper plant and equipment first. You can't just do the first adjustment separately and come to the other one. You have to read these all five together. That depreciation that relevant to the proper plant and equipment, and then you have to move with the adjustments. So that's why I told you this is the hardest one, right? And office equipment depreciation. So it's simple because there is nothing any there's no any adjustments that are relevant for the office equipment. So 12,000 useful life 5, so 12,000 divided by 5, currently depreciation should be 600. So all these depreciation, the office equipment depreciation. Um, so yes, 12,000 divided by 5, 2,400. So the current year depreciation 2,400 you have to mention in administration expenses. But the others two you already recorded in, added in to the cost of sales and the closing stock, right? So that's it, right? The land of the business. Yes, I didn't mention the land revaluation. So land revaluation, uh, the difference of that you have to, okay, the land revaluation because I can't go back to the previous, right? So that's the case. The land revaluation, I think it's surplus, right? Wait, wait. Yes, the land of the business was revalued for the first time for 6,400 on 31st March 2023. So land given the cost is 7,000. So 7,000 worth land you are revaluating for 6,400. So which means you are getting the revaluation loss 600. So that you should deduct from the note number 4. And in the last year it says mm, it's nothing given, right? Yes, there is nothing given for the land revaluation, so which means the total land revaluation loss you have to record in other expenses. And sixth adjustment is relevant to the lease case. The company obtained the right of use of building on 1st of April 2022 to use as its office for a period of 5 years. So this is what operational lease. So you are using this building only for 5 years, right? So which means you have to do the depreciation based on the lease terms, not the useful life of that, because you are using this building only for 5 years. The useful life of building is 25 years, so it's unnecessary information. The ownership of this building is not transferred to the company at the end of the lease term. At that point, you have to decide whether you are doing the real depreciation based on useful life for lease term. So if it is not transferred to the business, so which means you have to find out depreciation based on lease term. The present value of lease installment as at opening date was 21,000. According to the lease agreement, five equal installments of 5,000 each is required to be paid over the lease term, and the first installment was due on 31st March 2023. However, the company failed to pay the first installment on the due date, and it was paid on late after the financial year. The lease interest for this year and the next year, 1,280 and 1,055. And assume that there is no down payment or initial direct cost of the lease. The present value of lease installments has been debited to the right of use of asset and the credited to lease value. So, which means the opening initial transaction they recorded correct, and no other counter entry has been made. So, the cost of that lease you have to get as 21,000 because it says there is no down payment or the initial direct cost. So the 21,000 of that building lease value is also your cost. And you are using this for 5 years. So 21,000 divided by 5. Your depreciation for currently is 4,000. And you are getting this building for your administration purposes. So that depreciation you have to record in administration expenses. And the remaining carrying up, so you have to mention in SOFP non-current assets. Right? And when it comes to the lease creditor, the opening balance was 21,000, and the current year interest is 1,280. So that amount you should mention in the finance expenses as well because it is an expense for you. And also that interest you have to pay to the lease creditor. So that's why it credited to the lease creditor also. So this is total balance that you should pay to the lease creditor, 22,480. From that, the installment payable you have to credit to the lease creditor account. Either you paid in cash or not, you have to credit that installment to the lease creditor. So that's how you can find the closing balance. But it didn't pay at it. So that amount you should record in other payables as lease installment payables. And then you can get the closing balance of lease creditor as 17,200. And this 17,280 you have to split between current liabilities and non-current liabilities. So how to find the current liability portion? You have to get the nesting interest. You have to subtract nesting interest from the nesting installment. Because here in the other, here under current liabilities, we are showing the credit portion that you are settling in next year. So the installment that you have to pay is 5,000 annually, and the nesting interest is given here in the adjustment 1,055. So which means 3,945 is the amount that you are settling in next 12 months, simply in next year. So that is the amount that you should record in under current liabilities. And the total lease creditors that you have to pay is 17,280. From that, you are settling 3,945 in the next year. So the remaining balance you have to mention in non-current liabilities, right? So that's how you are doing lease creditor adjustment here. So this is a lot of information, but comparing to the other adjustments that given in the protocol report as we discussed earlier, this is a bit easy. This is a very basic lease uh, adjustment, right? So as like this, it can be given in the long format information, but you have to read it and then you have to get what's the simple idea, right? So don't be afraid if they give us a lot of questions. So just read and then underline what are the important facts and important information given over there and basics, right? And sales forum. The company sells goods with a 1 year warranty, and the provision for warranty as at 31st March 2023 was estimated as 1,150. During the year, 600,000 was spent on repairing the goods under the warranty, and it is included in the distribution expenses. So first of all, you have to minus that 600 from the distribution expenses, because the 600 that you are paying in this year in cash is relevant for your last year's sales. So you can't mention that in the distribution cost. So that's why the warranty paid, the repair cost paid, you have to deduct from the distribution cost. And we can record that in the account. So in the trial balance is given the sales warranty opening balance 800. And the closing balance it says 1,150. So this 1,150 you have to record in current liabilities. And the amount that you paid, you have to credit to the sales warranty account. Then you can find out the sales warranties that you should identify in the income statement. So that is 950. So you have to deduct the 600 from the distribution expenses, and then you have to write down 950 in the distribution expenses, right? And then tax. So income tax paid shown in the trial balance consists 450 and paid for the previous year, and the tax paid for the first 3 quarters. The total income tax liability for the year ending 800,000. So the total tax provision for this year 800, and tax provision for the last year that appeared in the trial balance 350, and for last year you paid 450 this year. So which means you did a under provision in the last year, but you can't go back to the last year and then correct that. So that under provision that comes from the last year, you have to adjust to the current year, right? So the tax for this year is 800, and the under provision that comes from the last year 100. So your total tax you should identify in the income statement should be 900, and the total tax provision 600, and the tax paid appeared in the trial balance 1,100, and that's include the tax payment for the last year 450. So which means you paid tax for this year in cash 650, and then you can find out the tax payable amount 150, and that 150 tax payable you have to mention in current liabilities in SOFP. The stated capital of the company as at 1st of April 2022 consisted of ordinary shares issued 10 per share. The company capitalized retained earnings in the portion of 1 share for every 5 shares, and however, no entry has been made. But further, the company made a public share issue 10,000 on 1st of January 2023. And this is proposed. So when you find the opening number of shares, you have to minus that 10,000, because this 10,000 happened within the year, right? So your share value as at opening date is 30,000, and the number of shares as at opening date is 3,000. And then you can find out how many shares that we issued when you do the reserve capitalization. So 3,000 divided by 5,600. So value of reserve capitalization is 6,000. Retained earnings debit and share capital credit. And last one, director fees 1,500 has been included in the admin expenses. So that's my expense given. The 1,500 you have mentioned in the admin. In the row number 2 under the price. And the interim dividend that you paid 800, that included with the administration expenses. That is totally incorrect, because when you pay the interim dividends, you have to mention that under retained earnings in the changes in equity, not because the interim dividend payment is not an expense for the business; it's a way of distribution profits. That amount you should mention in the retained earnings, right? So that's it for this question. And again, this is the hardest one ever. Comes in A levels, A levels in past papers, right? Okay. So keep in touch for the other questions as well. And I already uploaded a lot of past paper discussions from 2019 to 2023. So we'll meet again. Thank